to turn our attention in this next section of today's agenda to look at what impact investing is. Investing in this way is not a compromise between economic returns just for the sake of doing good, but it actually leads to better returns and the creation of enhanced impact along the way. So, to expand on this, both from an academic and a practical standpoint, and considering economic trends and recent case studies, I would like to welcome back our panelists. Please put your hands together and welcome Nick Moon, Chair of Circulate Capital, Casey Rayner, Founder and Director of A Future Worth Living In, Anna Shield, Chief Investment Officer of Better Society Capital, and Emma Thorne, Partner for Bridges Fund Management. Thank you very much for joining us. I think it's probably nice just to help everyone understand the sort of ecosystem if we go through our panelists and just share a little bit about our backgrounds and sort of what we do. So I'm going to start with you, Nick.
Thank you. Hello, everyone. Good afternoon. My name is Nick Moon. I'm the chair of Circulate Capital. My background is about 25 years in private equity, but always in the field of impact investing. So as was said just now, creating financial returns, competitive returns, but doing that in a way which creates good, positive impact in whatever investment theme your focus is. Circulate Capital, a few words about us. We are a dedicated investor in emerging markets to prevent plastic pollution and to encourage recycling. So we're a private equity fund. We manage funds across South and Southeast Asia and Latin America, and we focus on companies that are recyclers or in waste management, particularly in plastics, but also in textiles, paper, and e-waste. About 5% of the global carbon footprint each year in the world comes from the process of creating plastic, and about 12 million tons of plastic waste goes into our oceans each year also. And it's our mission to try and help alleviate those trends for the better. Our investors are insurance companies, institutions, private investors, development banks, but also a whole load of corporates as well. So we have investors, people like Coke, Pepsi, Danone, Unilever. And the reason that they invest is because they themselves are all trying to reduce the use of increase the use of recycled plastic in their supply chains. And so working with us, getting access to our portfolio companies is a symbiotic relationship for them in moving towards their own sustainable targets, whilst also providing huge value for us and our portfolio.
Thank you very much, Nick. And Emma, Bridges was one of the first movers in this space, and you're bringing essentially 20 plus years of experience from your business perspective to this. Can you just explain a little bit about your background and what Bridges does?
Absolutely. So hi everyone, I'm Emma Thorne. I'm a partner at Bridges, and I've spent the last 10 years of my career there with a background in more sort of generalist private equity. Joined the team at Bridges very motivated by doing private equity in a slightly different way, absolutely focused on impact, but also very much aligned and motivated to deliver strong financial returns. And we absolutely see the lockstep between the two, and that one certainly shouldn't come at the expense of the other. So in terms of the background on Bridges, as Zara said, we've been around for over 20 years now, one of the first movers in the impact space. All of our focus is on supporting the transition to a more sustainable and inclusive economy, and we do that by investing in private businesses, in real estate, and also in outcomes partnerships, all focusing on delivering positive impacts aligned with positive financial returns. My focus at Bridges is on what's called our Inclusive Growth Fund. Just a bit of background, we've seen a huge amount of capital flow into the impact investing space over the 10 years since I've been at Bridges, but a very large proportion of that is increasingly focused on the decarbonisation theme. We sort of, first of all, don't think you can look at decarbonisation in isolation of reducing inequalities, but also do see the benefits, particularly now, of really starting to specialise in terms of our fund's focus. So my fund is exclusively focused on social impact, very much in the UK, a real place-based focus. And we're looking to invest equity checks of typically £5 to £15 million for minority or majority stakes into businesses that are delivering very clear, measurable outcomes, helping widen access to essential services, which very much includes health and education as the core tenets of the strategy.
Thank you, Emma. And Anna, we're obviously hearing about environmental impact here and those sorts of goals that exist within this space, but of course there's social goals, which Emma did touch on as well there. Perhaps you could explain a bit about your background and what you do.
Absolutely. Hi, everyone. So I'm Anna. I'm Chief Investment Officer at Better Society Capital. I have been doing that for just over 12 years, which coincidentally is about the same time that Better Society Capital has also been around. Prior to that, I was working in kind of more mainstream investment banking, working with financial institutions. So Better Society Capital is an impact investor focused on the UK. And we were created in 2012 in order to really try and create and build a market where much more capital flows to the solutions to the social problems we face here in the UK. So the principle and the belief behind that is that we do have these entrenched and challenging social problems related to homelessness, mental health, to name but a few, but that there are also enterprising solutions to those coming from a whole range of sectors. But we need to crowd and increase the ways that capital can come to that. So that's really what we were set up to do in terms of increasing and building that social impact investing market. We've been doing it for, as I say, just over a decade, and we've committed over that period of time about £1 billion to over 100 different funds and other kind of intermediaries that are helping to support those enterprises to increase their impact. The other thing that I think we've really seen over that time period is that growth in the market. So we track how big the UK's social impact investment market is. And our last market sizing shows that it's about £10 billion, which is more than 12 times more than it was in 2011. So just to reinforce, I think, the message is there's that real increase in momentum from investors. But of course, what that's also coming together with was lots of innovative solutions from impact-driven entrepreneurs and other businesses that are looking to tackle those problems.
Thank you very much. And Casey, last but not least, a future worth living in. Does what it says on the tin.
Yep, absolutely. And that's why I set it up, was really because that was the burning question of my time spent within asset management and working with asset owners was, when we're allocating capital, how do we ensure that the way in which we're allocating the businesses that we're investing in are going to help us create a future that we all want to live in. And I think that's one of the big challenges that large-scale investors are now facing into, with increasing scrutiny through regulation, forcing them to take a long, hard look at what their money is doing. It began with the Task Force on Climate-Related Financial Disclosures, with forcing large-scale investors to look at their carbon footprint and look at their climate risks and opportunities. But that kind of exposure is now focused in on nature and social as well. And so investors are starting to realize that it's not only impact investing, where investors intentionally invest to create a positive impact, it's also across the whole scope of their investments. Fundamentally, all investments have an impact. And what we're starting to realize is that those negative impacts of our investment decisions are causing detrimental issues within society, both at the climate change level, but also at the societal level as well. And so my work at A Future Worth Living In is still very much focused on asset managers and asset owners and helping them understand where they are on their sustainability journey and what the next best step for them is in terms of changing their investment philosophy and beliefs to incorporate the impacts that their investment is having.
Interesting. Now, before we dive in, because I would love to ask you all for some case studies to help paint a picture a little bit more clearly in terms of what that looks like and what you really do. But just to remind everyone that we are, of course, using Slido. So any questions you have, please put them to our panel, and I'll do my best to get through as many of those as we can. But just before we get to the case studies, I'm thinking about impact investing as like angels with wallets. It feels, is it that the case? And if so, or if not, can we maybe get a definition from someone? I'm wondering, maybe Emma, if you would like to help define what impact investing really is.
Great question. And actually, as a big part of Bridge's mission over the past 20 years has been to try and do exactly that, because everyone has such different interpretations of what impact investing is and actually how you measure it. And it's vitally important that there is that shared understanding and sort of common approach to measurements and communication. Otherwise, bluntly, no one knows what they're doing and where they should be investing. So how we've approached that is thinking very carefully and specifically around what we call the 5 dimensions of impact, but most importantly, sort of the what outcome are you delivering, how do you manage that, and how do you ensure that that is a positive outcome, and then who is receiving that outcome. So I won't sort of go into too much technical jargon, but if we can be really clear about that we're having a positive what for someone or something that needs it, very often the planet, then that's how we're trying to define as crisply as possible.
And so then in what ways is it different, or does it vary when you compare it to traditional forms of investing, Nick?
Well, I firstly agree with everything Emma's just said, but I think probably for me the difference is intentionality. Yeah. Impact investing is investing with a clear intent to create positive good, whether it's in climate or financial inclusion or healthcare, whatever your thematic strategy is. Whereas a non-impact investment would be investing in the business case, the financial returns, but without the positive intent of whatever those outcomes are. And most impact investors also look to apply their value add in helping to create that positive intent as well. So, for example, we bring skills at Circulate to help create more recycling at scale, which is great for the business investment case, but is also great for maximizing the impact.
And so, Anna, where are the priorities? Is there a certain compromise you have to make as an impact investor on ROI?
Great question, and in some ways it's one of those ones that keeps coming back in terms of the development of the sector. I mean, what I'd say just to sort of build on sort of what we talked about is absolutely intentionality and measurability is key, but something that we also think about is starting with the social issue as a principle of an impact investor. So starting with understanding what problem you are trying to tackle and where can you then bring an enterprising solution to it and align that with what an investor can bring to that. So is it both the right type of capital, and can that enterprise then deliver the returns on investment that investor is looking for? And I think the really important thing to bring out is that the impact investing market is not homogenous. It's not about a single type of business and a single type of investor. It's pretty varied, actually. So we have real estate funds investing in social and affordable housing and other vital infrastructure. What they're able to deliver to their investors is a sustainable long-term income with some inflation, which aligns with what investors like pension funds are looking for. At the other end, we might perhaps see sort of early stage tech startups that are tackling problems like financial inclusion and mental health in a very different way, bringing the power of technology. That's a higher risk proposition, of course, because it's seed stage, early stage investing. But again, because the investors see that the potential there to align purpose and commercial returns, that can then also line up with what those kind of investors are looking for. So I think it's a long way of saying I don't think there has to be that trade-off. I think what's absolutely critical is bringing that alignment between social purpose and mission, ultimately drivers as the business and the returns, and then the right types of investors in alignment with their expectations. And what's fueled the growth in the market, the 12-fold growth that I talked about, is because we're finding those spaces. We're finding those places and spaces where you can get that alignment to come together. And it's why we've seen, for example, the growth in impact startups and the real sort of burgeoning of a community of impact venture funds who see that purpose and impact can drive value, obviously social value, but also financial value as well, as an example.
Well, we're going to dive into the metrics of all of this very shortly. But before that, actually, I can hear there's a little jangling on your mic. I don't know if anyone else can maybe hear this. And then
My
sadly,
earring.
we're going to have to get you to take your that earring
Earring.
off, if that's okay. Just because I know that's what does it. These microphones wreak havoc with our accessorizing, don't they? We have a question that's come in anonymously that asks, how do we ensure impact investment does not contribute to greenwashing? Casey.
Yeah, I think there's been a huge focus on greenwashing, especially with the introduction of new regulations in the investment and fund space. We saw a whole raft of fund managers putting the word sustainable on funds and classifying them according to new criteria, only to kind of downgrade them quite quickly thereafter. So I think the first thing is having that clear definition of what is impact investing and making sure that there is transparency around that. I think probably having some kind of regulator input in terms of the oversight mechanism, and that's really kind of what's caused the focus on being much more transparent and clear on the metrics in the larger scale investment world, was the threat of censure, but also having the kind of written down rules to adhere to. And I think the key with greenwashing as well is that who is the audience? And what is it they're expecting? Because you can have all these different rules in place, but actually if you've got a fundamental disconnect between the customer who's buying the product and then the investor who's allocating the capital, you can have this kind of unintentional greenwashing happen. We saw it when we conducted some...
And it's not just greenwashing, is it? There's a term, impact washing,
Yes.
that exists. So it covers social causes as well and social funds.
Yeah, and certainly what we see in that space is where investors are claiming that they're having an impact that is not necessarily an impact that's been driven by their investment. So kind of say that the causation and correlation effect of saying, well, we invested and therefore this good thing happened. I think it's less prevalent at the smaller scale, kind of giving loans to much smaller businesses. But where you do see it kind of manifest is in much larger investments. If you're looking at listed equities, for example, and starting to claim some impact in that space, well, that would be a little disingenuous.
Excellent. Thank you very much. I hope that's answered the question. I think it has very thoroughly. Now, what we'd love to do is understand some case studies. And I'd like to come to you first, Nick, to ask, you have a massive portfolio in the circular economy, and this is what you've been talking about. You exist in South Asia, Southeast Asia, and in terms of what you're seeing and who you're working with, some of the businesses especially, or even just the funds, I wonder whether you can give us an example, a case study that will help to illustrate more succinctly what it is you do, to help paint a picture.
Sure, I will try my best. A good example for us would be one of our portfolio companies in India. Firstly, why are we investing in India? Well, it's because over half of the world's plastic waste and pollution comes from Asia. So if you want to try to solve that problem, that's where you need to be operating to hit the level of scale required. And India itself is an interesting market. It's over 1 billion people, yet the government is very progressive around plastic waste regulation. So in India, 30% of all plastic that's used in a country of over 1 billion has to come from recycled plastic sources. And in 2 years' time, that goes up to 50%. So that gives you the backdrop of what is a very strong set of regulatory drivers for growth in the industry. One of the businesses that we back there is a business called Lucro. They specialize in fast-moving consumer plastic recyclables. So these are things like ketchup sachets or shrink wrapping that you'd get around fast consumer goods, things that typically would get discarded into landfill. And they developed a technology to break that down and to be able to recycle that into high-quality feedstock, which can then be on-sold to international corporates that require it for their supply chain. So when we backed them, we put about $13 million in to do two things. One, to increase their production capacity, and the other to increase their collection footprint. And 4 years later, we've grown their production capacity by about 7 times and opened 16 new collection centers across the country. So things have been going very well. They should be delivering about 350,000 tons of plastic waste savings through their activities, and they've been growing about 30% per annum. So for us, they're a great example of a company that is meeting a real commercial need, but is doing so in a very impactful way. And McKinsey estimate there's about $100 billion worth of capital required to be invested into the types of businesses like Lucro in order to meet the existing pledges by corporates to meet their own sustainable packaging needs by 2030. So there's a whole universe of companies out there which we think are like Lucro, which should and could require backing. So hopefully it will be the first of many.
Well, it's a great example that shows the reach and the growth potential. I'm wondering, Emma, if you have a great example of impact investing that you've seen within your time at Bridges that you could share with us.
There's lots. I'll share a couple just to try and bring it to life a bit more clearly. Both on quite a different scale, actually, but both with very deep impact on that sort of UK-focused social side. So the first is a business called New Reflections, which is a business that provides extremely high-quality care to some of the most vulnerable children in our society. We invested in back in 2017, and what the business does is provide therapeutic care and also education to children with very severe emotional and behavioural difficulties and also severe learning disabilities. It's an area which I'm sure you'll have read about in the press over the years. A huge amount of public funding is going into children's services, and there's a huge focus on what constitutes value for money, and also, most importantly, quality, and also a really big question around what is the role of the private sector playing in this part of the market. And I think it's a good example of where I think sensitively we feel that there is very much a role for private capital with that real sort of mission-led approach and purpose that is focused on quality above all else, and sustainable growth that is then going to gradually bring in and increase capacity into a sector that badly needs it. So that's been a very long sort of term hold for us. As I said, we invested in 2017. We're very much still invested and sort of will carry on to be. Over the course of our ownership period, we have managed to sort of more than double the places in terms of the number of young people that the business looks after. But that has been done through this very careful, absolutely sort of quality-led approach, which we feel is appropriate for the sector, but that has still delivered a good investment return for us over that period.
So there has been a good investment return in the sector, because I'm wondering what traditional types of investors might make of an opportunity like that, whether they would maybe initially be turned off because they wouldn't see the immediate profitability of something like this.
Yeah, exactly. I think there's a very fair argument around sort of what sort of sustainable profit looks like in that area. I think another sort of sector on a very different, a case study rather on a very different scale is Agility Eco, which is a business that sort of helps match funding to vulnerable households to help reduce their fuel bills by installing energy efficiency measures. That's a business that we invested in 2019, exited in 2023, so a 4-year period, and over that period worked with over 200,000 households and helped them on average reduce their fuel bills by between £300 and £500 per year. So a really meaningful impact. Also a huge decarbonisation side as well. So 1.5 million tonnes of carbon abated through the measures that were installed, and as a result of that scale up, a very strong growth trajectory, and again a strong return back to the fund as well. So that a nice example of that sort of interplay, I guess, between both the social and the environmental impacts.
And 2 great case studies. I think that quite often storytelling is the best way to paint a picture of what you're doing, and often I find it's the most interesting, isn't it, understanding how something works. I'd love to know from yourself, Anna, if you have examples of best practice.
Gosh, that's a hard one. There's so many examples of best practice, but perhaps something that kind of illuminates some of the elements I was talking about a little bit before is the Fair by Design Fund, which was something that was created in 2016. And the origins of that were really some work and research that showed that about 14 million people who are living in poverty pay fundamentally more for their basic goods and services, so for energy, for financial services, for food. So that's clearly a huge social problem. It's clearly an injustice. I mean, the quantifications of that are it's perhaps over £3 billion in terms of what that costs. But it also posed the question at times to, is there actually a solution to that that's driven by businesses coming up with better goods and services for people that are on lower incomes, seeing them intentionally as a customer base that they can support and provide for, rather than perhaps a customer base that is inconvenient or not one that's profitable. So that was the origins of something called the Fair by Design Fund, which was brought together really with insights from actually Joseph Rowntree Foundation, who are just experts in poverty and understanding that, brought together with a venture fund manager who had that expertise in terms of assessing and building ventures to create a venture fund looking to support those early stage startups that were going to tackle that problem differently. So in the years that have ensued, that's made a number of different investments. Examples of that range from a business called Switchy, which is working with social housing providers to provide smart meters for people living in social housing that are also not Wi-Fi dependent, so that that's not potentially a barrier. Or WageStream, which is working with employers to allow lower income staff to be able to draw down their salaries on a more gradual basis so that they're not having to go to the payday lenders or the other kind of exploitative sources of credit that people tend to go to. And if you sort of pull that then together in terms of what's that delivered, well, there's evidence showing that that's saved about £250 million for people living in poverty in terms of what they might have paid otherwise. But also importantly, I think that the fund manager has gone on to raise a successor fund tackling the cost of living. And that's really important because that's providing that continuity and that growth that shows that we're continuing to build on that. So I think that brings together a number of facets of starting with the social issue, really seeking to understand what the business and enterprise solutions are to that and what their returns are, having robust measurement along the way, but then also looking to build on that, to sustain, to grow, to build momentum around it.
Thank you very much. And thank you to everyone who so far has submitted questions on Slido. I'm going to get to as many of those as possible because I can see them pinging in. There is a question that's come in. Casey, I'm going to put this to you. Are we moving towards putting value on social or environmental benefits? Value created through ecosystem services, for example, not just financial returns. So I assume this is, as a society or as investors or as and globally, are we moving towards valuing social and environmental practices and benefits?
I think the conversation has certainly started about valuing them conceptually with some of the new frameworks that have come out and recognizing the value that they provide to the economy. I think we've so far shied away from putting a price on some of these elements, and I think that's for a couple of different reasons. I think fundamentally there's a challenge around setting a carbon price that's effective, that works in a globalized world. So if you set a carbon price in one country and another country doesn't, do you then kind of create incentives to buy goods and services because they're cheaper from a country that doesn't have a carbon price? But fundamentally, I think that's the way we will have to go within the economic system that we're in if we truly want to value something and to invest in it in our financial model. It needs to have a price. We've also seen the introduction of new regulations through the biodiversity net gain elements for property developers that also start to help create a market in that they have to ensure that they're investing in nature. And so that is also starting to send a price signal. So fundamentally, yes, I think we are starting to value it conceptually, philosophically. I'm not sure that we're yet at the point where we have a reflective price that reflects its value.
Well, we'll come in, hopefully we'll have time to talk a bit more about policy and regulation and its impact and its changing landscape as well. But we have a question that has come in anonymously asking what percentage of the 12% or 12 times growth in the impact investing market happened in the last 3 years? And how will it continue to grow in the current interest rate environment?
I don't think I can. Sorry, I don't think I have exactly what the last 3 years' data is. I can definitely look. We have that data. I think we saw about 9% growth in the last year. So the interest rate environment has had a bit of an impact, as you'd expect. It's almost impossible for something that's intended to slow the rates of investment not to have that effect. But what we found interesting, actually, is that in some aspects, the social impact investment market has been more resilient than mainstream markets. So, for example, looking at the venture landscape, that's been a hugely challenging fundraising environment. I think others alluded to that in the last couple of years. But we have continued to see growth in the number of funds that are looking to raise impact funds and some that have successfully closed over that time period. I can certainly come back with the exact data on what the last 3 years looks like.
Thank you. I'm sure we can try and fit that in perhaps for the Herald article tomorrow, or we'll figure that out, how to get that in. Thank you. Another question that's come in anonymously asks, what are the main things impact investors base their investments on? So the main considerations, Nick?
Well, firstly, it would be a whole array of things that a non-impact investor would make a decision on. So the financial viability of the project or the company that you're investing in, the projected return versus risk profile. And then on top of that, it would be I guess the authenticity of the impact that you think can be achieved by whatever the project or the company is. How does that align to the exact measurements and outputs that you're seeking as an investor? And then also, I think the values alignment of the management and the leadership in charge. You know, it's important for impact investors to feel a strong alignment with the investee company on the achievement of impact.
Is it important for these businesses to demonstrate growth economically within their sector for investors to really believe and understand and want to invest in them and their cause?
Absolutely. This is not soft investing. This is investing, but investing for good. And just look at the growth of the industry. I mean, the question prior, I can remember 15 years ago at one of the early impact investing conferences where people were celebrating the industry was worth 4 billion. Wow. We were talking shortly before that we started about one fund that's in the market at the moment raising 10 billion, just one fund. You know, people estimate it in its trillions now. This is a hugely fast growth asset class or industry, however you want to label it. And it's because it does deliver commercial returns, and it does so by making the world a better place. And what's not to like?
Excellent. Well, it brings me quite nicely to yourself, Emma, because obviously impact investing, it goes beyond ESG. And, you know, when we're looking at the economic trends, potentially, how do you view them changing in future, and what's the direction of travel at the moment?
So a couple of trends that we're noticing at the moment, and I think I've alluded to one already, but I think there's definitely a move towards specialization around what outcomes are being delivered. So ultimately, this is all about outcomes delivery. But we are increasingly seeing LPs be more specific about what outcomes they're looking for. So, you know, is it a European asset manager absolutely focused on decarbonisation and therefore fairly sort of agnostic geographically about where that decarbonisation is happening? But that will be sort of the key link for them in terms of where they want to be investing their money in which funds, and then equally actually a real focus on actually that sort of deeper social and place-based impact as well that we're seeing, and is very much what my fund's been born out of. And I think as we sort of see more communication about the objectives of the Mansion House reforms and where a lot of the local government's sort of pension money is going to be going as well, really excited to see sort of the next stage of that, but very much sort of hoping that, you know, place-based and local will still be very much attached to meaningful outcomes and outcomes measurements, rather than just sort of going back almost to sort of what Bridges did in its very early days, which was sort of postcode investing, which is one way of thinking about it, but we actually sort of, we do want to really get into those measurable outcomes.
Casey, would you like to reflect on this as well, the future?
Yeah, I think it's, I mean, we're obviously facing into some pretty rocky territory in terms of what's happening in the US, but if we just put a pin on that for a minute, I think the emerging trends for the institutional investors and for the very large pension schemes are being driven by this awakening piece around, oh, actually our investment helps to create the world around us, and at the moment the world's not looking great, so maybe we need to do something about that. And you rightly said the focus has very much been on how do we decarbonize our portfolios. For many investors, they're moving beyond that question now into, okay, so what are the solutions that I want to invest in? And I think that's where impact investing absolutely comes in. I think we're also seeing the government start to be a little more heavy-handed in terms of the Mansion House reforms. And I think there's this sense from players in the industry, a concern almost that if they don't get their act together and start doing something about having a positive impact with the trillions of pension money that they're looking after on behalf of all of us in society, that they'll start to see Treasury launch a fund and be told they have to invest 10% in it. So there's absolutely a sense of the asset management and asset owners wanting to get their house in order before somebody else comes and puts it in order for them. I think the other big trend that we're starting to see is this real desire, and you talked about, was it angels with wallets?
That's it.
Is that it? Okay. So
That's
I think,
how I see it in my
yeah,
mind.
I think there, in my mind, it might be actuaries with wings. So like in lots of pension schemes, the investment team is all actuaries, and they work with models and spreadsheets and things like that. But really, for me, it came home when I was talking to an investment committee, and the actuaries had updated their investment philosophy and beliefs to move beyond models and to recognize that they wanted to generate a reasonable return for their beneficiaries, recognizing that their beneficiaries were going to retire into the world that they were investing in. And they hadn't yet quite qualified that in terms of what that might mean in a model, but the concept was in there. So in my mind, if we can get the actuaries to have wings and then find out how to make the money flow from all these big pension schemes without it being necessarily through Treasury, then we start to see a much greater impact. And I think the seeds of that are growing.
Thank you, and appreciate the imagery, as I hope you all do too. Sadly, that is all we have time for on this panel. There were so many more topics and questions that we would have loved to put to you. I'm terribly sorry that this is all we've got time for. I'm going to ask you to stay seated for now. A big thank you to Nick, to Emma, to Anna, and to Casey.